headed into what looks like the fourth straight winning session for the S&P 500 SPX. That index is up 3% from when the Fed started its hiking cycle back in March 2022. While that may not look like much, it does speak to markets taking all these rate hikes fairly in stride. That said, Wednesday's bullish session driven by inflation data relief has chased away some valuation worries, says Louis Nevelier, chairman and founder of Nevelier & Associates. He says the S&P is now trading at 24.8 times earnings on a trailing basis and 21.2 times forward earnings. These are bull market levels, beyond a soft landing scenario, though clearly skewed by the weight of the very high multiple megatechs. The risk at this point is that even if the earnings season is strong, how much more of a rally is possible? He ponders to clients. We may soon find out as earnings season is about to get underway. Switching gears literally is our call of the day from Morgan Stanley, whose strategists say investors and Tesla TSLA enthusiasts ignore the power of China's might in the auto sector, internationally and domestically, at their peril, as they flag 3 investable names. According to equity strategists led by Edward Stanley, global automotive is one of the few sectors that is at the heart of their 3 big themes this year: tech diffusion, multipolar world, and decarbonization. On that first point, they see global auto brands losing around 8 to 10 percentage points of market share due to challenges from cheaper electric vehicle (EV) exports and a falling internal combustion mix, with margins at risk from the companies involved. The vehicle margins of global brands stood at 24% in 2022, compared with 15–19% for Chinese brands, perhaps making the market complacent about the potential gross profit margin convergence between the two over the next decade, said the analysts. As for the multipolar world theme, they see China already scooping up market share in Europe. While Tesla has successfully established EV hegemony, the undersupply of affordable EVs remains a global challenge. Consequently, China-made EVs are infiltrating developed markets, rivaling global peers with superior affordability, variety, and quality, said Stanley and the team. Volkswagen XE, VAO3 for example, has around an 18% share of China's internal combustion engine market. That is the less climate-friendly car that pukes out carbon monoxide, etc. But just a 2% slice of China's battery electric vehicle market, they say. Fueled by increasing multipolarity, this balance is set to worsen for the incumbents. By 2030, we expect Chinese brands to have a 30% EV share outside China. The investment implications and protectionism they ultimately face will vary by region, but this is not deterring Chinese investment, said the bank's strategists. Finally, on that decarbonization theme, Morgan Stanley's base case implies 40% global EV penetration by 2030 and 30% offshore market share for China-made EVs. Around $280 to $360 billion of capital expenditure would be needed during this period, they say. If all of the above plays out as the bank thinks it will, they see EV makers BYD 002594, NIO, and XPeng as the biggest beneficiaries. The latter two, as many are aware, have U.S. listings. Longer term, Renault FR Arno, Honda JP 7267, VW, Ford F, Stellantis, STLA IT, STLAN, as legacy original equipment manufacturers, OEMs, would be more challenging, said the strategists. For Western OEMs to avoid this, Morgan Stanley's slow EV case scenario would need to play out, meaning 25% global EV penetration by 2030 and 15% offshore market for China-made EVs. This appears to be an increasingly unlikely outcome, however, they add. Subscribe now for more update.